Property Principles 101, and today we are focusing on part 2 of our Coffs Harbour series, where today we will be deep diving into the due diligence we perform on a property and a street level around how we assess an investment and determine whether it is worthy of our attention. So, as mentioned, this is part 2 of our Coffs Harbour series. We did throw the question out to you, our audience, on High Performance Property Investment Group over on Facebook to determine the area to focus on firstly, and then within that area, which individual property they would or you would invest in. And this property here is the property that was selected. So this is 9 Morrison Close. Just reiterating, it wasn't us as a company or myself personally that selected this property, it was you, the audience. And what I'm going to be doing today is I'm going to be unpacking this investment. I'm going to be running the same filters across it that we would professionally here at Ripehouse Advisory, and to determine if it is a buy or not. So let's just start with the property itself. It's obviously on realestate.com now, early December, 9 Morrison Close, Coffs Harbour. It's a 1970s, 1980s brick property. You love these old brown bricks. They do date very well. With these types of properties, we have typically tried to, improve the street appeal of them by painting bricks or even rendering bricks. Painting these bricks actually comes up quite well if you do a light grey colour. Removing a lot of these window shades or coverings or external coverings that do date the property. But all in all, as you'll see in a moment, we actually haven't included a budget on this property for improving the exterior. It does present relatively well, and it does suit the wider street demographic and the other properties in the property. So, look, let's just dive into the property itself very quickly. Obviously, the front view here, good backyard, good block size for the area, good level block. Good square block. It's not irregular shaped. It's not near power plants. It's not near power lines. We do about 30 different checks on the street area itself. The block itself is very well located. It's a level street, so it's not on the high side or the low side. We're not having issues there. Internally, obviously very tired and dated. Okay, you're looking at the carpets here. The internal paints, it's looking neat and tidy. It's a pretty neutral colour. Arguments would be, potentially painting it just a white colour, a whisper white, and a base reset, especially these kickboards down the bottom. But all in all, the paint's quite tidy on this property. Moving through it quite quickly, obviously dated kitchen. Obviously dated kitchen from another view, dated bedrooms, and dated bathroom. So there is a renovation required on this property to maximise its value, its broader appeal, and its renovation potential. And so therefore, you're able to increase the rent and then artificially increase the yield you have on that property on your cost base through this type of reno. So I'll come back to that in a moment. But we're just getting our bearings there. Outdoor area. Now floor plan, let's analyse this. So we've got, where's the entrance? Let me get my bearings. So entrance through here from the front of the property. We've got a bedroom over here with a shared or an ensuite type setup. So this is the main bathroom with an ensuite into here. We've got a sunroom, so based on council approvals or council requirements, that may be able to be legally converted into a 4th bedroom. This would mean you've got services, so you've got services over here already. What I mean by that, you've got water services over here already, and you've got some dead space here. So you could look at converting this into an ensuite and into the master bedroom. So creating a suite here if you were. So you could turn this in from a 1, 2, 3/4 bedroom into a 4x2 relatively easily. Obviously the kitchen area needs full renovation. That faces off into this dining room, but this is all very dead space all around here. So depending on whether this is weight bearing or not, this walls through here, you could remove all of this and open the whole floor plan out, and that's modernising the property. Older properties of this era did have small contained bedrooms because that reduced heating costs. Now it's all about opening up floor plans and modernising the property. So you could do something there. With this dead space through the middle. We've also personally put beams into properties. About $4,000 per beam is what it's cost me in the past, where even if this is weight bearing, you leave a pillar and you run a beam across it. That's a great thing you can do. So the floor plan on this one is actually relatively well laid out as it is, okay? It is very sort of consistent with the era of the property, but there is scope to dramatically improve upon it. Now, we haven't gone down that path in this assessment. We've gone to the baseline renovation, around the $25,000 mark. So we've kept it at a light cosmetic reno, but there is arguments for going down this path of a more substantial reno, up to sort of $60,000, $70,000. Let's keep skipping through. So this gives us our bearings. Let's just jump onto the map view quickly for this property. Coffs Harbour, the beach. This is obviously the most expensive and attractive areas for Coffs Harbour. You've got the CBD areas over here, and then you've got a lot of employment down here in the south. You've obviously got the hospital complex, which is where the $200 million extension, $194 million extension is going in. So you have a lot of employment here, and a lot of natural utility through here. Okay, it's a small regional airport, so even air traffic and noise is not really going to be a concern for this, even with this proximity, but you're not really going to get the benefit either of being close to the airport in terms of transport with this size of city. So look, overall, it is in and around all of the key areas. This is a good established area with no scope for infill. Okay, no scope for large subdivisions and infill between here and the key providers of utility, which is the employment hubs, hospital, apart from this area here. So obviously you might have councils selling off land, rezoning, you might have potential with private landowners to develop through here, but no real potential between here and the key drivers of utility. So that's what we're really looking for. So there's no future risk of supply coming in and ruining our party. Hopefully that gets us our bearings around the property. Overall, floor plan is good, flexible options. Location is very good, positioned well in the city with no supply risk imminent. Let's take a deeper dive on a street level, shall we? So let's take one level deeper in. This is the old Ripehouse software. So this has been around in different forms now for 10 years. Each of these red dots are obviously on-market properties. This software is not available publicly. We use this privately here in Ripehouse Advisory. The property in question is just down here, if you can remember. I'm going to start putting some overlays on the property. So this is public housing overlays. The darker the red, the higher the public housing. So if we click on this zone here, it's got 26% public housing in the street. Okay, obviously anything over 10 or 15% public housing, it starts to have a dramatic impact on the street appeal of the property. You can tell. And I'm all for public housing, don't get me wrong, but you can tell, with the street itself. And prices, vacancies in the area are strongly impacted. We've done research in the past that talks about public housing impacting property prices by plus or minus 25% in the street area. A dramatic change. What that means, if there's 0% public housing in the street, you'd expect to have over 20 to 25% above average capital growth for that street when compared to the suburb overall. And if you have over 15% public housing in metro areas, you'd expect 20 to 25% less capital growth year on year compared to the suburb overall. So dramatic impacts around public housing, and you can see here a large cluster. So there's a couple of things we've got to be careful of with public housing. One, the street area doesn't have much, right? So let's have a look here. The street cluster, 6%. Okay, 1 in 20 properties approximately. That's not too bad. Okay, that's not really going to change. 7% just next door and 4% just north. Okay, so that's really not going to impact the street level. A lot of streets across Australia have some public housing, and it is integrated well into our communities. But these 25% or more pockets of public housing, that dramatically changes the makeup of that area. What you've got to be careful of is you want to make sure that there's not public housing in the streets immediately surrounding the property, but then you want to make sure that there's no public housing, further away from the natural drivers of utility. And so, look, it's not relevant here in this example, but if there was all this public housing here, or maybe here, and people walked through your properties to get to the employment hubs, then it's very similar, or has a similar impact on your property, whether you're in the public housing or they walk through your public housing to get to transport hubs or employment or shopping. Okay, so you do have to be careful if there is public housing surrounding your property, that they're not using you as a thoroughfare, all right, or your street as a thoroughfare. So you have to be careful. No concerns here around public housing. Who lives in the area? Okay, in the green areas are predominantly owner-occupiers. All right, so we have only 20% renters in the street that we're in. That's okay. It might be slightly on the low side. I typically like to see around 30-35% renters in the street. We don't want too many because it might hold down property price growth, but we do want to be in an area that does have good, strong rental demand. So we're on the low side, acceptable there. Property type, lots of houses, very few units. We want to make sure we buy a house in this area. Let's go here into rents. We are in a higher than average rented street. Good strong rents, and let's check out yields as well, and good strong yields as well. So we're in above average streets, above average for yield and for rent. We're in an okay pocket for occupancy type, definitely in the right pocket for buying a house. Okay, we're not going to come into this area and buy a unit, and this is a house in question. So we're getting some matches through here. Overall, the street level analysis of this is very good. Is it in a Ripehouse approved sweet spot location? So these orange areas are combining all of these elements together to tell us, is this a Ripehouse approved sweet spot? And it's not. And the reason why it's not is because that occupancy type is just slightly too low, slightly too few renters. Remember, very high owner-occupier type or areas. Let's have a look here near the beaches. Very strong owner-occupier clusters here. Owner-occupiers are great for driving capital growth, for improving properties, for driving value growth through the years. But in these owner-occupier clusters, you might have higher vacancy rates or volatility in the rental market. You might have very low yields because rents don't move much and prices continue to grow, so yields fall behind. We'd like to see some renters around that 30% mark is what we've seen as optimum, to give that backbone into the market for us as investors. Okay, so that would probably be the one downfall here, if I'm being really picky, that it has slightly, too fewer down here at 22.3% renters, slightly lower than optimal, but it's still okay. Okay, it's still acceptable. So look, overall at a street level, we would be comfortable with this. It's not perfect, but it's very rare that an area is perfect. One thing that I would watch out for would be the number of renters in the area. That might have an impact on yields now and into the future. All right, so I might skip over just to do a little bit of the suburb and the street analysis. So this is using one of our research reports. So we generate these reports. We can actually generate them automatically from our systems. This is taking a deeper dive maybe into some of the information that we've already covered at a local government area at a city level. Okay. So this is the one that we're looking at. If you can remember back to the city and the local government area analysis that we did do, we were looking at the purchase on the buy and the rent side dynamic to determine if this was a buying window. And we did determine that we've actually probably hit a market top in Coffs Harbour, at least for the little while. The buy point in Coffs Harbour was March into April of this year. But we've continued down this process of analysing a property, okay? So we threw the keys to you as an audience to choose a location. You chose Coffs Harbour. We determined it wasn't particularly a buy point, but we've still continued down this example and selected a property to analyse, which is what we're doing now. So if we were forced, gun to our head, to buy into this area, is this suburb area a buy point as well? We've had vacancy rates decreasing throughout 2021. So this is a bullish signal at a suburb level. All right, that's strong. We've had rents gradually and slowly increasing, which is also a bullish sign throughout 2021. And we've had yields stable, okay, if not slightly decreasing. That's, with stable, we would like to see in a perfect world yields increasing in line with rents, but it's very difficult in this scenario because we have had strong price growth throughout 2021. So, that's good. This is just okay. We've seen days on market trending upwards. Okay, so that's showing us that the steam's coming out of the market once again. That's probably not a bullish sign. That's something that we need to have an asterisk next. And we just have had a spike in sales volumes in the recent weeks and months. Spring selling season, we've had a lot of interest clearing through the market, but we've also had a lot of supply coming into the market as well. So overall, we would assess this area as in the top 22% of all areas across the country. So it's in the top 1 in 5 suburbs across the country. So it's good. It's not quite excellent. It would be acceptable. It would be a good entry point into a suburb if the broader local government area and city was a little bit stronger. In isolation, this is not enough to justify an entry. Okay, so this is just an example, obviously. If you were, gun to your head, forced to come and operate into this market, we're definitely focusing on houses. We're definitely focusing on 3, if not 4 bedroom properties. And we are focusing on the lower side of the suburb median, and the lower side on the rental market. So up to about 650,000 is the optimum sweet spot. The top end of the market is a little bit patchy. It's not giving us the confidence that we need. On the south side of the median of this area is giving us the potential on the upside that we're looking for. So we are focusing on the lower side of this market. Now, before we get into the property push assessment sheet, I did want to mention that if property research, market observations, due diligence and news items are of interest to you, then please subscribe to this channel and make sure to select the bell icon so you are the first to hear of any new updates. Now, this property in particular, let's go through our assessment sheet. So this is our standard, nuts and bolts of a deal. We put these assessment sheets together to assess whether this property would meet our numbers based requirements. Okay, so it's not looking at more broader, softer elements. It's not looking at the suburb or the street or the floor plan, etc. This is just looking at the numbers of the deal and determining if it stacks up to our requirements. So I'm going to flick through a number of assumptions. We've assumed for you as a person, 90% LVR, interest only, 3.1% interest, 30-year term, paying LMI. Okay, so that's the base level assumptions. Obviously, we have the property details over there. Good block size. All right. Let's have a look at the costs for this acquisition. Purchase price. It's on the market. Let's have a look what the listing is at the moment. On the market for $695. Now, our buyers agents have had a chat to the agent. They've looked into the market. Okay, they've dug into what's going on. And even though it's on the market for $695, they feel that the actual sale price for this property is going to be $710,000. It's obviously liable to change, but as gun to our head, as of now, on market for $695, we feel that it would sell for $710,000. So we call that our estimated sales price for this property is $710,000. Based on that number, we've calculated all the buying costs. We've looked at the reno. We've suggested a bathroom, interior paint, floors and bedroom floors with a $26,000 reno. There is an argument, obviously, that we can go far further. So we've just assumed that it's a very light reno, just the absolute bare, the worst elements of the property to improve, and that's not even including the kitchen, which, as obviously we saw, does require some work, and potentially the floor plan. You could easily argue that you could spend 3 times this amount on a cosmetic reno. New kitchen, 15, 17, 18 grand, a new bathroom, moving some plumbing around, new floor plans, opening up that floor plan, removing that wall. You could arguably spend a lot more than this. For the purposes of this example, we've kept this at an average reno. Most clients would come to us and not really wanting to go that full degree, wanting to spend around, 5 to 8% of the purchase price, keeping it at that sort of one large ticket item, in this case, the bathroom. So in this example, we've identified a $26,000 reno as a good value uplift, as a good bang for your buck. We've got some holding costs here, rates, waters, insurance, property management, $2,000 a year in maintenance. So this is going to help us with our, so that's going to total $147 a week in holding costs, not including interest. So that's our assumptions. Coming here into our value assessment, our comparative market analysis, we've got 3 comparables, pretty direct in nature. Okay, August sold, better flooring, similar land size at 720. September sales, similar land and house condition at 710. And we've had a superior comparable here in September also. 2 bathrooms, similar land size at 750. We've looked here at what the property would potentially be worth after the renovation. All right, so after the bathroom and the floors, we're looking at a $760,000 value. So a nice amount of uplift for your $26,000 spend. So we're going from around $715,000 valuation. This has been done by one of our in-house senior valuers, up to $760,000 after our reno. On the rental side of the equation, $520 as it is now, up to $550 after our $26,000 reno. Okay, so that's all the data, that's all the numbers. Let's put it all together into an assessment sheet. So we do feel, as it stands today, we could negotiate it for $710. Anything south of that, that's a bonus. So with an appraised value of $715, purchase price of $710, we're $5,000 under market value. That's good. In this environment, anything south of valuation is good. Estimated reno costs, this is a light cosmetic reno, the base reno you would do on this property, $26,000, but we were projected to be worth $760 after the reno, 1.7 times return on your renovation costs for $19,000 profit. Okay, rental appraisal. All right, after all costs, we've got an appraised rent of $550 after the reno. On all costs, our yield after that reno would be 3.9%. So it is cash flow negative before taxes based on all of our assumptions of $62 a week. We've projected in this market, based on our research, 7% future growth over the next 12 months. So that's a projection. It's not quite of the calibre of our high performance growth locations, which are 10% plus. 7% at the moment is average. Okay, this market is not fitting to us, giving us what we need to classify it as a high performance growth location. So we've got 7% earmarked for projected growth for 12 months for our capital growth profit. We combine these 4 elements together, we've got a total profit in the deal of just under $74,000. The cash required for this acquisition is $144,000, $145,000, giving us a 1-year recoup of capital percentage of 51%. So this is a number that we are interested in. This means you put $100,000 in this deal, you get $51,000 profit back in the first year. This for me is not enough. It's not acceptable. For me, a minimum 1-year recoup of capital percentage is 65% or above. All right, I want to put $100,000 into a deal, get a good deal on the entry, get good cash flow into my pocket. I want an investment paying me each week. I want it to pay me for the privilege of being in my portfolio. It's a business, it needs to pay the bills. Okay, so this is too low for me. This is good, this is good. I prefer stronger capital growth fundamentals. Okay, we saw here that the local government area, it's not acceptable for me. We've missed the buying window. Overall, this recoup of capital percentage is too low. The deal is not a goer for me. Now, this property, you'll remember, was highlighted and provided by you, the audience. Okay, so it's a useful exercise. It's an interesting exercise. I think it's been a very positive one, but very early on, within the first 5 minutes, this property was ruled out for us. And the reason for that was because it's in a bushfire prone area. All right, so very simply, whilst we might, never be impacted by bushfires, we might be, and for the next 100 years, there's no bushfires in the area, that's okay. It is still highlighted as a bushfire prone area. It's going to impact your insurance policies in many cases, but what it's also going to do is it's going to limit the buying pool for people potentially in the future that will consider this property. And whenever you have limitations on the people who are likely to buy this property in the future, you're going to have substandard capital growth and difficulty to even rent the properties. It only takes 1 or 2% of people not interested in the deal to just take the heat out of any sales campaigns in the future. And if you're not selling this property, you'll go, well, that's fine. I want to invest and hold this property long term. Well, it still impacts you because next door might sell, okay, and they have a substandard sale campaign. Less people are interested because of the bushfire area, and then they don't generate the sales result that they require. And guess what? Your property is valued next to its peers, its comparable properties. So your ongoing capital growth is impacted by their results. So even if you don't sell, you are impacted by bushfire-prone areas. Look out for any of these overlays. There are many heritage, native overlays. Flood overlays is the biggest and highest impacting flood overlays in the country. This for me is a deal breaker, okay? Even if it's an acceptable property in all other scenarios, it's just not worth it. It's a big country. Let's get fussy. Let's go out there and have a look at other alternatives. And by the way, if you would like to view more market observations, property research and latest property investment news, be sure to check out the other videos on this channel. Thank you.